Okay. Hi, everybody. Welcome to our first Financial Ninjas Real Estate Zoom call. We are very excited because we have Marco Santarelli, who is here today to give us a breakdown. He is an expert on real estate investing as passive income. And so I am delighted that he's agreed to come and speak to our group to give us a presentation, to break it down for us a bit, and you guys can ask him questions at the end. And yeah, so we'll see. We're going to take a look at this. I've talked with him about possibly doing a couple presentations. So this one might be a little bit more of a overview, and hopefully we'll be able to get into some specifics in this presentation. And if we need to have another presentation to get a little bit more into details, depending on what your interest level is, we'll be able to do that as well. So I want to thank Marco so much for coming and doing this for us. He's a very busy man, as all of us are, busy professionals. So we really appreciate it when people spend their time to share their expertise and knowledge with us in a way that can help many more people. So let me just turn it over to you, Marco.
All right. Well, thank you very much, Faith. I appreciate the opportunity to come on and share some information with everybody. And if you'd like, I can do an intro first and then kind of share the screen and go into the PowerPoint. Would you prefer that?
Yes, absolutely.
Approach?
Yeah,
okay.
Please.
Okay, so just real quick about me. I live here in Southern California. I think maybe a number of people on the call here are from California. I sometimes jokingly refer to it as the Socialist Republic of California just because it's so expensive and people just are crazy with the regulations that are here. But I have this trademark saying to live where you want, invest where it makes sense. And I've lived by that saying since 2003. So for the longest time, I was living in Orange County and investing over 2,000 miles away in states as far south as Florida, as far north as Michigan. And many of the properties that I was purchasing at the time were sight unseen. I had a team. It's not that I was just blindly investing, but I had my fair share of mistakes. I've had my fair share of successes. I've made a lot of money. I've lost a lot of money, and then I've made a lot of money again. But through the process, I've learned the systems and methodologies to be able to successfully invest in other markets and do it effectively and do it successfully. And so what ended up happening is after I purchased my first 84 properties, which I did in a 9-month period in 2004, I decided to systematize what I was doing and share it with virtually everybody else. And how did that happen? I had investors coming to me saying, Marco, you're lighting a blaze behind you. I see what you're doing. You're buying a lot of property. It's great. Can you mentor me? Could you coach me? And my answer was typically, no, I'm sorry, I don't have the time, which was the truth. But I said, look, I see a lot of properties. I see a lot of deals. I don't buy them all. Some are good, some are bad, but I'm happy to share them with you. And that's when the light bulb moment went off and I realized, yeah, you know what? There's a need for someone to be out there vetting and finding these deals for other investors and doing a lot of the legwork, essentially 70% of the work being done for them. And that was the niche that I discovered, and it ultimately became the business that I have today of Norada Real Estate Investments. And so my whole team here, we're all investors. I'm still actively investing, both actively and passively, and still continuing to build a portfolio all over the country, not in the state of California or any of the other expensive bubble market states. But I love what I do. My team loves what we do. We love talking about it. We love sharing. We love educating. I'm a big believer, like Robert Kiyosaki, and the whole thing about being a perpetual student. Always be a student. Educate yourself. And share that knowledge. And there's just so much good information out there today that there's really no reason or excuse not to be educating yourself, especially when it comes to your financial future. And so long story short, I'm just, I consider myself an entrepreneur and a real estate investor, and I have been since I was 18 years old. And that's actually when I bought my first rental properties as soon as I turned 18, because I could qualify for a loan. And the writing's on the wall. That's when it all happened. Anyway, that's a little bit about me. And I guess we're going to leave some time at the end for some Q&A from what I understand here, right, Faith?
Yes, absolutely. And I also just want to clarify for you guys. So we have two real estate investor experts who are going to come on and speak. Marco is the first one. I posted a video for Adiel Gorel. He's going to come on potentially next week and talk too about his method. So I think it's really important that you guys get a vision of that kind of either what they both say that coincides with each other, right? Or if they have different ways of investing. And you can get a feel for what you think will work for you as well. But either way, you're building your base of knowledge, which will hopefully, my hope is that this gives you a comfort level that maybe you didn't have before, a knowledge and a comfort level in being able to actually take action. If you have the kind of little pocket of money that will allow you to do this, to be able to get started and take action. So that's what my goal is with these things, not just to get information, but to get the kind of information that will allow you to act. All right, take it away. You can share.
All right. Yeah, I'm going to share my screen here.
So feel free to ask questions. You can ask specific questions. Later on down the line, he's going to give us kind of the broad overview, and then we'll dig into it a little bit more. And if you have a lot of very specific questions, we may do another presentation.
Okay. All right. Let's see if this works.
Got it.
Does it work? Okay. So you see the first slide, because I'm not sure what I see here. Okay, cool. All right. So I just need to flip screens here in order for this to work. Okay, so I talked a little bit about who I am, and this was the slide, Faith, I was referring to that, talks a little bit about me. But, like I said, I invest in real estate full time, but really I love to run my business, which is Norada Real Estate Investments. And that's what I spend most of my time doing, is just helping other people. My company has a mission of helping 1 million people create wealth and passive income through real estate. And it's a big, lofty goal, a big, hairy, audacious goal, but we are well on the way, because I started this business 16 years ago, and we've helped thousands and thousands of people. But what I can't count is the tens of thousands of people that my podcast reaches, and all the content and whatnot that we put out. But essentially, I created a company here, which is a nationwide provider of turnkey cash flow investment properties. And that term turnkey is kicked around a lot. And I marketed the bejesus out of it back in 2003 and 2004, when people really weren't using that term all that much. And today people use it all the time. Unfortunately, it means different things to different people. So we have our own definition of what turnkey really means in terms of properties and an investing style. But last year we were named number 925 on the Inc. 5000 list with Inc. magazine, which is a thing I'm very proud of. It was kind of 15 years in the making, if you will. And the company continues to grow. So we're very happy that we can help a lot of investors achieve financial independence, financial freedom, and passive income. So as I mentioned, I'm not going to go into this, but I purchased my first rental when I was 18, and the writing was on the wall at that point. So I'm the host of a fairly popular podcast on iTunes. It's in the top 50 in business. It's called Passive Real Estate Investing. And, I like to say it's the show where busy people learn how to build substantial passive income and create wealth for the long term. And its website is passiverealestateinvesting.com. So enough about me. You can ask me questions later if you like. Here's a question that I like to ask, and I'd like you guys to ask yourself this question right now. If I said to you, finish the sentence, ignorance is blank, what would you say? Now, you don't have to unmute yourself. I'm not expecting you to answer it here. But
Costly.
what is it?
Costly.
Absolutely. Yeah, absolutely. So most of the time, 99% of the time, people will say, well, ignorance is bliss. And for some people that may be true, but the reality is I like to say that ignorance is expensive because what you don't know is costing you opportunity. It's costing you money. The better educated you are, the more often you will identify opportunities and the better off you'll be in identifying and vetting and underwriting opportunities out there, particularly in real estate. And so the more knowledgeable you become, the more effective and successful you'll be as a real estate investor, or for that matter, anything you really do. So to me, knowledge is critically important. It's my number one rule of successful real estate investing is just to continually educate yourself. All right, so what I like to start off with is just asking the question, what kind of investor are you? Or maybe the question is, what kind of investor would you like to be? I classify real estate investing or investors specifically into two general categories. One is a passive real estate investor, and the other is an active real estate investor. An active real estate investor is typically what you're going to see on TV shows like the HGTV Fix. What is that? Flip or Flop? Or
Flip and Fix or something. I don't know what it is, but
there's a
yeah.
bunch of them, right? Exactly. So, the person who's out there swinging a hammer or managing a crew and fixing up a property is, by some people's definition, real estate investing. I don't consider that real estate investing. I consider that a job or a business. And the more you do, the bigger your business. And you can make a lot of money, you could lose a lot of money. But ultimately, what you're creating is equity or chunks of cash. You're not always creating, well, in fact, you're never creating streams of cash, which is what passive real estate investing is all about. If you are an active real estate investor and you're buying distressed assets or distressed properties, fixing them up with the intention of keeping it as part of your real estate portfolio for the passive income, then that's great. Then you're both passive and active. You're creating these assets that are generating passive income and you're putting them in your personal portfolio, and then you're shifting from being an active business owner or an active investor, as some people will call it, to a passive real estate investor. And I love the passive model because I want to focus on choosing markets and properties, putting them in my portfolio, letting my property manager manage the property so I don't have the brain damage of having to actively manage anything other than just my books, my QuickBooks or whatever it may be, once a month, every month, just to see the income coming in and the expenses going out. But I like to build my portfolio as passively as possible with the help of my team. And that's the kind of investor that I choose and prefer to be. And I think a lot of people are in that category because at the end of the day, we're all busy. We have our jobs or careers, unless we're staying at home because we're furloughed or, we're under a lockdown. But generally speaking, we have our careers and we have our family and we have our friends and we want, to live our life, work when we have to work, and then socialize and do the fun stuff. So we don't really want a second job of being, actively involved in real estate, but we still want to invest because we want to create wealth and we want to create passive income. So this is what you have to decide is where you are. And sometimes you have your foot in both. And I've actually renovated and flipped close to 300 houses. And I can tell you, I don't like it. I did it. It was profitable at one time, but it became very, very draining. And so I don't want to be doing that anymore.
And the other thing, if I can interrupt you for a second, is that I want to make clear is that sometimes what people consider passive real estate investing when you're not fixing up a property, maybe you just purchase it. But if you're still managing it, like you're still finding the renters for it and, accepting the rental check payments and, sending people out if there's a call, to fix the toilet or whatever, that's not really passive either. To the IRS, that might be considered passive, but it's not really passive income because you're actually having to actively manage the property. So I want to make that distinction. So a lot of people have been burned in that area.
Right, exactly. So if you're managing your own portfolio, your own properties, or some of them, maybe not all of them, because you're geographically diversified, then yes, you're still a passive real estate investor, but you're an active manager. You're actively managing your own passive portfolio of properties. So, but that's a good point. Yes. So this is kind of a myth related to real estate investing that I kind of I kind of cringe when I hear the media talk about the real estate market. You know, how's the housing market is the question that's always asked. And the thing is that there's really no such thing as a real estate market or a housing market. And the reason for that is because all real estate is local. The media refers to real estate as this one giant nebulous blob, and they call it, you know, the housing market or the real estate market. But you can't point your finger at the housing market. Where, you know, show it to me. Where is it? It doesn't exist. The fact of the matter is that all real estate is local, and you've heard this saying probably many, many times. And the reason for that is all local markets, and there's over 400 major metropolitan statistical areas around the country, but they all have their local economy and their own local politics. They have their own local business environment and business laws and zoning laws and regulations. But most importantly, they have, excuse me, I zipped ahead there. They have their own supply and demand dynamics, which affects pricing, both in terms of rents and the housing pricing. So what you have to understand is that all real estate is local. And why that's important is because what happens in one market is going to be very different than what happens in another market. So what happens in San Francisco, California is going to be different than what happens in San Diego, which will be different than what happens in Houston, Texas, which will be different than what happens in, let's say, Detroit, Michigan. Every market is different. So at a global level, kind of a macroeconomic level, you have some commonality in terms of things like interest rates. You have these macroeconomic drivers. But most of what happens in real estate happens at the local level. And so I think if you have that in mind and you live in an expensive market, like a bubble market, like Southern California or the coastal markets around the country, then you will realize that what is happening here locally may make it difficult to invest while there's opportunities in other markets. So that just means that your local market may not be the best market to be investing in or trying to invest in. You might be banging your head against the wall trying to find deals or things that actually cash flow when they're going to be rare at times. So what are the differences between the markets? These are the things that I look at and I like to look at. I'm just going to move something off my screen here so I can see what you're seeing. So the differences in the markets are really things that are ultimately driving the market, which often happens to be the businesses that are located there and the political and business environment and the tax environment that drives that local economy. So all markets have different drivers. Markets have different cycles, and sometimes they actually happen, well, often they happen differently between markets. So you might be in an expansion phase in one market, whereas another market might have topped off or starting to decline because it's unaffordable and overpriced. Median prices will differ, median rents will differ, property taxes differ, and that plays into cash flow and affordability, which is a critical piece, especially if property values go up a lot faster than the local incomes are going up, and that happens for a prolonged period of time. That becomes a problem. And then last but not least, something we call a rent to value ratio or RV ratio. And I'll get more into that here in the next couple of slides. But these are just differences that you will find as you compare one market to another, to another, to another. So again, it goes back to that whole concept that all real estate is local. And when you realize that, then it's liberating because you realize that I don't have to invest in my backyard, like the so-called gurus say. And that's another myth too, is a lot of the so-called gurus are suggesting that you invest within a 1 or 2 mile radius of where you live. Why is that? Well, the reason is because a lot of these so-called gurus are assuming that you can still find good deals or deals period where you live in your local area within a 1 mile radius of where you live. But that's not true for everybody all the time. And so if you live by that rule of thumb or that guideline, you might basically be putting, handcuffs on your hands and limiting yourself to what you're going to be able to do in terms of real estate investing, or maybe not be able to invest in real estate at all. So what is the solution? It's really invest in the best markets that you can find and the markets that produce the best returns. And believe me, they are in the US, they are available all the time, regardless of the economy or the economic conditions that we have. If we're in good times or bad, recession or otherwise, whether the stock market is high or low, people need housing, people need a place to live, and the real estate dynamics differ from market to market. So it's a matter of finding the best markets that provide the best returns. All right. From a high level, there's really three kinds of markets, and this is really how we classify real estate markets. There's different ways to classify markets, but this is how we look at markets. There are markets that we refer to as cash flow markets, and these are markets that are essentially optimized to provide a good cash-on-cash return for your invested dollar and good regular income. They're affordable markets. They're typically mostly a blue-collar type of market. They have a very good rent-to-value ratio, which, again, like I mentioned before, we'll talk about here in a couple of minutes. But these are markets that are great to invest a chunk of cash and have a portfolio of properties that are just kicking off $200, $300, $400 per month per door and generating just a stream of income. And Birmingham, Huntsville, Memphis, Tennessee, these are good examples of what we call cash flow markets today. On the other side of that spectrum, we have what we refer to as growth markets. And these are markets that are more prone to price growth, or what you would call appreciation. Now, I would never suggest, and my team here would never suggest, that you chase after appreciation or you invest solely for appreciation, because the cash flow is critically important. In fact, it's something I refer to as glue. It's the glue that holds your deal together, because you want it to float and fund itself. You want it to carry itself while that equity grows over time. And so a lot of our clients will actually build a portfolio made up of both growth and cash flow properties in various markets. So growth is really more focused on appreciation or price growth. Atlanta has been a very strong market for price growth over the last, let's say, 5-6 years. Same thing with Dallas. Houston is kind of more of a hybrid market right now, but it was a growth market for a period of time. San Antonio certainly was a growth market. So these are markets around the country that are appreciating much faster than its historic norm, and it's appreciating faster than the real rate of inflation. And so those are growth markets. Now, there are also markets that are swinging from one of these markets to the other side of that spectrum, and you're getting kind of the best of both worlds, and we refer to those as hybrid markets. And those are markets where you're seeing good price growth, and you're also seeing a tremendous number of cash flow opportunities where you have good cap rates, where you have good cash-on-cash returns on your invested money. And examples of those markets are Indianapolis and Jacksonville, Florida, Chicago, the greater Chicago metropolitan area, which actually spills into the northern part of Indiana, and Kansas City, Missouri. These are hybrid markets where you're getting great cash flow opportunities, and you're also at the same time getting strong price growth. Now, these don't last all the time, year over year. Markets are constantly in a state of flux. There's no equilibrium. It's like a pendulum swinging one way or the other. There's constant change. Maybe not fast. Memphis has been essentially a cash flow market for a very long time, so it's not shifting quickly to become a growth market. But recently, because of strong demand, we've actually seen Memphis starting to appreciate, parts of Memphis appreciate faster than what it has in the past.
Marco, can I interrupt you just for a second on that previous
Absolutely.
slide? Just to maybe, we go back to the previous slide for a second, just to maybe clarify it a tiny bit. So when you're saying cash flow market, what you're saying is that basically your mortgage, the money that you're getting from rent is exceeding what you need to pay the mortgage. And so, and by perhaps a relatively significant amount. I don't know what you could tell me what would seem reasonable, a third or I don't know what. But a growth market is where you're more relying on the actual value of the house to grow, but potentially would the mortgage be like mortgage plus housing costs and property tax, et cetera? Would that still be completely covered by the rental payment, or may or may not be fully covered by the rental payment, or at least you're not going to expect to see much overflow of cash after all those expenses are paid? You're just kind of sitting on it, letting it pay for itself while the property appreciates to a point that you sell it and take the gain in more of a lump sum.
Faith, that's a great question. So when we talk about cash flow, we're talking about what's left over at the end of the month after all expenses are covered. So it's truly the way we talk about it, but this is also by definition. Cash flow is really what's left when you take your revenue or income and you deduct all your expenses. But if you take it one step further, which is what we do, what you have to assume when it comes to income producing real estate, you take your income, which is the gross rents, and you deduct, I'm getting a little ahead of myself here, but you deduct your vacancy allowance. Even though it's not vacant, you're budgeting for an occasional vacancy. And there's a percentage that we use, which is kind of standard practice. So if you take your revenue or your income, you deduct a vacancy allowance, and you deduct your expenses, which are essentially property taxes, insurance, right? Your property manager, and if there's HOA fees, you deduct those HOA fees. And then you also deduct maintenance and repair. Now, you're not necessarily paying for maintenance and repairs today, but you're budgeting for it. What's left over after you do that is your net operating income. You deduct your mortgage payment, and what's left over after that is your cash flow. That's a true net number. It's spendable cash. You can put it in your pocket, and you can spend it tomorrow. That's what we're talking about when we're referring to cash flow. It's positive cash flow. So these markets that we're talking about are, first of all, anything that we look at, anything that we invest in, and anything that our clients invest in are all positive cash flow. It's just that the cash flow is stronger in cash flow markets than it is in growth markets. It's kind of like a give and a take. If you're in markets that have strong appreciation potential, they're sometimes a little more pricier. You're giving up a little bit on that cash on cash return or that cash flow in lieu of that strong appreciation potential. So what you're gaining in equity, you're kind of giving up a little bit in cash flow. Now, that's a long answer to your question, but again, for the sake of clarity, cash flow is positive cash flow. It is what's left over. It's spendable cash. So hopefully that makes sense.
Yeah. And he's gonna show a diagram which shows the calculations, sort of a sample of that. But you definitely don't want to be in a situation where your expenses on the property exceed the income coming in. That would defeat the purpose.
Yeah, so we don't need to get too wrapped up into this particular slide, talking about growth markets or cash flow markets. Just understand that markets are doing different things at different times in their life cycle, their market cycles. Sometimes markets are cash flow markets. Sometimes they appreciate for a long period of time, and because of the drivers, and they become growth markets. And so what you gain from that market is a little bit different in different periods of time. And that's all that really means. So there's 4 things that we look at when it comes to choosing a market. And again, you don't necessarily need to know how to do this. It's just that you can do this. So there's 4 main things that we look at when we look at a market across the U.S. The first is a market that is stable versus being a volatile market. And really all I mean by that is there are markets that are growing rapidly, and sometimes over time they're very cyclical. And we see that in the coastal markets, like particularly in California, where there are years where it appreciates very strongly, and then there are years where it pulls back and property values drop considerably, sometimes double digit. That's what we refer to as a cyclical market. people will refer to that as a volatile market because it can appreciate rapidly and strong for a period of time and also pull back pretty strong in your equity, which is just on paper evaporates. You compare and contrast that to markets that we refer to as linear markets, where they kind of grow a little bit each and every year over time. But if you were to look at it on a graph, it's more of a soft wave than a roller coaster. And so they grow consistently over time, but usually in the low single digit or mid, like 4 to 5% average rate of appreciation per year. That's a linear market. It's kind of what we would refer to as a boring market. And that's fine. It's fine to have a boring market because we love boring markets, because you know you're going to get over a long period of time a consistent growth in property appreciation, but you're going to have strong cash flows in those markets. So we prefer to be in linear or stable markets versus volatile markets most of the time. Again, we're not advocates of speculation like a lot of people did in 2006, 2007, before the housing market crash, where they were buying properties thinking they're real estate investors, but in reality, they were speculators. They were buying properties in the hopes of that property continuing to appreciate because they were going to flip it or sell it a year or 6 months down the road to someone else and walk away with a chunk of cash, a chunk of equity from the flip. Well, that is really just speculation, and that's really not a form of investing. So we're not that type of person. I don't like investing that way. So the second thing we look at when it comes to real estate markets is a diverse economy. We want to make sure that the job profile and the industries within that market are very broad. I don't like one-trick pony markets. Markets like North Dakota this is a great example. When the oil and gas industry was booming and oil was over $100 a barrel, you couldn't keep up in North Dakota bringing people in to fill the jobs that were there and provide housing for those people. Those people were literally living in tents. There were fields of tents because there were no available housing units to house these people, and all the hotels were filled. So when the oil sector softened and the price of oil came down, all of a sudden they were capping wells and jobs were being shed, and there were pink slips and all kinds of things were going on, where now people were moving out. And now you had a glut of new inventory there because all these builders were building like crazy, and now you have all these empty housing units. That's a market where you see it so reliant on one or two industries that it's kind of feast or famine. I don't like that. I really want a stable economy, a stable job market. I want a broad economic base within a market. The larger markets are typically by nature this way, whether it be Houston or Los Angeles or Dallas. You have virtually every type of sector within that local economy. So that diversity is critically important because it adds stability. So if there's a disruption in one sector or one part of the economy like oil and gas, it doesn't necessarily bring the house of cards down. In fact, there are no house of cards because there's just so much diversity within that market. So that's a critical thing when it comes to choosing a market. Third is it's ideal to be in a landlord-friendly state and a landlord-friendly county for that matter. You want laws to favor landlords, not be stacked against you because they are so in favor of the tenant that it makes it unfair for you to be able to evict or evict quickly if you have a problem tenant, which happens from time to time. Unfortunately, it doesn't happen very often. But look, people are people, things happen. People get jobs transfers, death in the family, whatever it may be. If they become problematic, you want to be able to properly and legally evict them in a quick, orderly fashion so you can get someone else in there. The reality is this doesn't happen very often, but certain states are unfavorable to you as a real estate investor, like California, for example. Whereas other states like Texas and Alabama, extremely favorable. If you have a problem, you file a quit or claim, pay or quit, and within 30 days you can have that tenant out and you can have a new tenant moving in because your property management company will, of course, handle all this for you. Last but not least is what I've been talking about a couple times now is that RV or rent to value ratio. All that simply is this, is what is the ratio of the monthly rent to the purchase price? And the example I always give is if you have a $100,000 property, which is very common in middle America, $100,000 three-bedroom home, if it rents for $1,000 a month, that's a 1% rent to value ratio. You just take the $1,000, divide it into the $100,000 purchase price or market value, and it gives you your RV ratio. You'll see this on our website next to every single property, because we try to stick to properties that are no less than 0.7% of an RV ratio, which means that $100,000 property rents for $700 a month, to about 1.2%. That's kind of the range that works. That's the sweet spot, if you will. It's ideal to have the 1% target, but if you look at a property in a good market, in a good neighborhood that has a rent to value ratio of around 1%, you know the numbers are going to work out. It'll give you a good rate of return. It'll generate positive cash flow. It'll carry itself. You'll have margin in there. It's just a litmus test. It's a quick metric to show you at a quick and dirty level what the cash flow and financial performance of that property will be without spending any more time doing due diligence or research on it. So the markets that we're in, of course, markets are huge. So you can have a high RV ratio in one area of the market and go to the other side of that metropolitan area and have a low RV ratio, because there's diversity within every market. But on average, if that market is showing that you can buy in investment properties, invested in properties in that market that give you that RV ratio of 1%, you know you're going to be doing well in that market from a financial perspective, financial performance perspective. So those are the four key things that we look at in a market. And of the 20 to 25 markets that we're in right now, they all check these boxes. Now we're going to kind of drop down a level and look at something a little bit more granular when it comes to the right markets. Is what type of neighborhood are you in? Every single market in the US, regardless of where you are, will have these different types of neighborhood classifications. It's just the way it is. You have different demographics in every single market, and people tend to cluster in different types of neighborhoods that have different income, different profiles. And those play into the neighborhood types. Now, when real estate investors talk about neighborhood types, they generally talk about A, B, and C neighborhoods or A, B, and C areas. This is very common in the commercial space, but it's also very true in the residential space. And so what I want to do is start with the C class neighborhoods for a very specific reason. I'm not going A, B, C here because I'm kind of building on each one of these. So a C-class neighborhood is essentially an area that is the cheaper areas within a particular market. Now you have to understand that this is market specific. A C-class neighborhood in Los Angeles is going to be $300,000 to $500,000 probably, whereas a C-class neighborhood in Birmingham, Alabama is going to be around $70,000. It's going to be a similar type of home, similar type of square footage, similar type of demographic, but that's an example of how different property values can be from market to market to market. This is why I keep saying that all real estate is local. It is very different between markets, even though you might have similar classifications and similar demographics of people within those markets and those neighborhoods. So a C-class neighborhood, the context here, by the way, are the markets that we operate in, the 20 to 25 markets that we have properties in. And at any given time, we'll probably have 150 to 200 properties available or in the pipeline coming down the pipe that are available for us to invest in, you to invest in, whatever the case is. But understand the classification. So C-class neighborhoods are generally, sub 100,000, but often around the 70 to 80,000 price point. They, on paper, will show higher rent to value ratios. So a $70,000 property probably rents for about $850 a month. So again, you do the math, you see that it's above a 1% RV ratio. So they look great, they look great on paper. And that's a key point, is a lot of real estate investors, I hate to say make the mistake of investing in areas by mistake, because what they're looking at on paper looks so good. The cash flow is good, the cash on cash return is very high, but of course it's going to be because the rent to value ratio is very high. So don't be fooled by that. Don't make the mistake. I made this mistake many times when I first started investing in real estate. I was buying a lot of properties in lower C-class neighborhoods. They caused me a lot of grief and stress and anxiety. On paper, they looked fantastic, but I found that over time, because of the higher turnover and the cost of the renovations, I didn't really have the cash flows that I expected to when I was looking at my pro formas, when I was looking at my forecasts for those properties. So just be very careful when it comes to C-class properties. Anecdotally speaking, but most property managers will tell you this, you have a higher turnover in these types of neighborhoods. You also have higher vacancies. The turnovers are more frequent, and the length of time to fill them is often more lengthy. But here's one of the biggest things that I don't like about C-class neighborhoods is the financing issues. Often you'll find properties that are in these C-class neighborhoods to have challenges when it comes to appraisals. And if the property doesn't appraise, you're going to have a hard time getting financing for it. You're either going to have a lower loan than you actually wanted, or the lender won't lend in that area, or you won't have enough comps or comparable homes for your appraiser to pull from in order to give you the appraisal that you actually need to justify the purchase price or the fair market value of that property. And so financing issues from lack of comparables is an issue in the C-class neighborhoods. Okay, let's go to the other end of the spectrum. Let's talk about your higher end primary, prime locations, your A-class neighborhoods. These are the kinds of areas that I like to live in, but they're not necessarily the best areas to actually invest in or have investment properties in. So again, within the context of the neighborhoods that we operate in, these slides were actually from last year. This really should probably say about 130,000 plus, but again, market specific. So higher prices means $130,000 to $150,000 or above. These are your A-class neighborhoods in the markets that we are operating in today. They have lower rent to value ratios, and this is just the nature of the beast. So $150,000 property probably is not renting for $100 or $1,500 a month. It's probably $1,300, maybe $1,350. If you're lucky, $1,400 a month. So again, a lower RV ratio, but they tend to appreciate better than properties that are in B and C class neighborhoods. The nice thing about them is that because of the demographic you're typically dealing with, you have lower turnover, and that just means that your tenant will often stay 2, 3, 4 years at a time. They just don't like to move. They get rooted into the community. Their kids are, rooted into the school system. They have friends and probably family in the area, and so you just tend to have a type of tenant that stays longer and also takes better care of the property. So lower turnover, lower vacancy, and very few financing issues. Why? Because it's a strong retail market, meaning you have a lot of comparables there for appraisers to draw from and justify property values. They also tend to appreciate the best in terms of any other classification in terms of neighborhoods. In the middle,
for the many people who live on the coasts, then what would be an A-class neighborhood price? That's like usually $1 million or more if you're thinking at California.
Yeah, well, as well as I do, it's especially coastal California, that could be, 800,000 to $1 million plus, would be an A-class neighborhood. Even in A-class neighborhoods in coastal Southern California, even the cheapest housing is typically what you'll find as condominiums, and those you're lucky if you find them in the 500,000 range.
Yeah.
So
it's very important to pick where you're investing and not feel trapped to invest where you live or to even purchase where you live necessarily.
Right. It just goes back to, live where you want, invest where it makes sense. If you're going to invest, you're looking for cash flow, you're looking for a rate of return. So you need to invest your capital where that makes sense, where you can actually achieve those returns and cash flows. So these B-class neighborhoods are what I like to call hybrid markets or hybrid neighborhoods. They're kind of like the hybrid markets. It's kind of a good middle ground. In the markets that we operate in, they're going to be in the 80 to 130,000 price range. Again, very market specific here. But the nice thing about these is it's kind of the best of all worlds. They have moderate RV ratios. Often they're going to be close to 1%. So you're kind of hitting that target, that loose target that we talk about. They certainly look good on paper. They've got positive cash flow, and that's a true net number of positive cash flow. They have moderate appreciation, average appreciation over time. Some years are better than others, but if you average it out, they're typically keeping pace with the real rate of inflation, sometimes beating that. And they have low turnover because they're still, again, in good areas of where there's low crime, good schools, maybe not the best schools, but good schools. It's really where what we would call the middle class live. These are certainly upper blue collar neighborhoods. So again, low turnover, low vacancy, and they're still easy to finance. Why? Because again, these neighborhoods probably have home ownership rates in between 50 to 70%. So there's still a lot of retail sales. There's a lot of buyer activity. Homeowners live there. It's an area where there's going to be a lot of comparables for the appraiser. So what is my personal qualifier? When it comes to neighborhoods, I basically look at it this way. If you don't have a lot of retail buyers, if you don't have an active, healthy, vibrant home buying market, then don't buy there, because it might be easy to buy, it's easy to get in, but it's going to be tough when it comes to sell that property because you're not going to have a lot of buyers to sell to. And the people who are looking in those areas, if they're not an investor, guess what? They're not going to have a lot of cash to put down as a down payment, and they're probably not going to have a lot, very good credit to qualify for buying that property. So you need to have a retail market. Otherwise, just move on. Okay, here's a quick example. I normally have 4 or 5 examples, but I just wanted to pick one for the sake of time because it illustrates the same thing anyway. So this was one of my properties in Kansas City, Missouri. This is one that I actually picked up 3 years ago and did a renovation job on it. I turned it into a turnkey rental is what I did. So this is actually an example of a property that's in a lower end A-class neighborhood. It was at that time $145,000. It's probably $170,000 today. Rents for $1,400 a month, so that's right around that 1% rent to value ratio. So it was kind of in the sweet spot of what I was looking for. And this is a classic 3-bedroom, 2-bath home that you'll find in Kansas City, especially that was built in the 60s and 70s. Now, the next part of this slide is going to have a lot of numbers and columns. I don't want your eyes to glaze over. I really only want to focus on 3 key things here. You will find what I'm showing you right here on our website. Every single property has an Analyze This button. When you click that button, it pops up a very detailed cash flow analysis tool along with neighborhood information and all kinds of great data. For those people who are analytical and like to just look at data, it's there. But the important thing to understand is this. Year one, when you close escrow on a property like this in an A-class neighborhood, what you're going to find is, and Faith, this is what we were talking about before. If you look in column 1 there, it's essentially your gross income for the year minus that vacancy allowance. You're not actually spending it, but you're budgeting for it. That gives you your total operating income. When you deduct all your expenses, including a maintenance reserve, because things will break, you're left with your net operating income, NOI. If you finance this, which I recommend you do, because one of the beautiful things about real estate is the ability to leverage your investments, you deduct your mortgage, and what you're left with is your cash flow. So a property like this should be able to kick off $250 to $300 per month, net, like spendable cash. I don't suggest you spend it. I suggest you save it and invest in the next property and the next property, and you rinse and repeat. You keep going. Or you just accelerate the payments if that's your strategy. Just pay down the mortgage faster and faster. That's a different strategy, it's a conversation for another day. But what happens is you have positive cash flow each and every year. In addition to that, you have equity growth. Why? Because over time, the property appreciates. And your your mortgage is being paid down by your tenant. So your equity grows because you're amortizing the loan, and at the same time, you're gaining appreciation over time. So each and every year, your equity will grow by a certain amount. Those two things together form part of what we refer to as your total return on investment. So at the bottom there, you have three important metrics, and there's actually more detail on our website, but your cap rate is the capitalization rate. It's what your rate of return on your cash would be as if you bought the property, all cash with no financing. But I don't like to do it that way. I like to actually borrow the 80% or 75% of the purchase capital from the lender and only put 20 or 25% down, because then I can buy more property, control more real estate, and I can grow my wealth a lot faster. But the rate of return you get on that 20 or 25% is what we call your cash on cash return. And that's often 8, 9, 10%. Sometimes it's in the the double digit range, like in Birmingham, Huntsville, Montgomery, Memphis, Tennessee. In these markets, it's not uncommon to have a 10, 12, even 14% cash on cash return. At the end of the day, when you factor in all of those things, your total return on investment in real estate is often in the 20 and 30% range. It's simple math. Some people don't believe those numbers because they don't hear it often, but really if you sit down and you pencil it out, you will see that your total aggregated rates of return across everything that you get from real estate is easily in the 20 and 30% range. Now, if I took this property, hypothetically, and I sold it in 5 years, based on the assumptions that you can change on our website, you can play with all the numbers. It's actually a calculator where you can change all the numbers and play with your own scenarios. You don't have to take ours. If I was to sell this property after 5 years, what you get is what people in the business call an IRR, an internal rate of return. It's essentially what your annualized rate of return is if you just take all your returns over the 5 years, sell it, and look at what you have left over. It's a 33.6% rate of return.
Sorry, can
Now,
I
I'm not
ask you
suggesting.
something? So is that the rate of return each year?
Yes.
Or is
Yes.
that the rate of return of after 5 years? That's each of those 5 years has a 33% rate.
Right. Right.
Right?
Because you're.
Okay.
Yeah. Yeah. Exactly. So. Oh, the comment I was making is that with real estate, you never really want to sell. If you ever sell real estate, it's not because you want to sell it or need to sell it. It's because you're selling it to take the equity out of that property and reinvest it right away into more real estate, what we call a tax-deferred exchange. So the beautiful thing about real estate is you can grow equity in property and then take that equity and use it to invest in more real estate, and that accelerates the growth of your wealth building and your cash flow and your ability to grow your portfolio and control more real estate and increase your passive income. That's a more advanced topic and really not within the scope of what we're talking about today. But, I just wanted to throw that out there because you don't sell real estate, after a period of time just for the sake of selling it. You sell it because you want to leverage the gains that you have in that property. So if we were to kind of simplify things down here.
Can I make one point here about what that last slide you were just showing us? There was a really important, very important, the cash on cash return. So when we're looking at in the whole kind of body of what we're doing with searching for different types of investments that we can make with our money. The interesting thing, so I've put a bar where I say, wherever my money is sitting, I want it to make 8% at a minimum. Now, some people are like, that's crazy because they don't know that you can get 8% on basically liquid cash money, but you can. So for me, that's my bar. I'm like, whatever we're doing, if we invest in the stock market, if we're investing anywhere, I want us to get at least a minimum of 8% annual return. So what's interesting about this real estate example is that not only when you're looking at the cash on cash return, what does that mean? That means your down payment that you put in there, right? So the money you put in, that's like the same money you might put in the stock market. That's that down payment plus those expenses, right, to make that purchase, that's the money you set in that was in your savings. So when we're saying that this is cash flowing, right, it means that $250 that you get each month, that's your little bit of that. In this example, it already exceeds 8%, right? But in some examples, in some of these properties, maybe it won't exceed 8%. It might be, 7% or something like that. And that's just the cash coming out of it. However, when you calculate in the appreciation of the property as well, then you actually can potentially get a much higher rate of return on that money you've put in than a minimum of 8%. So this is a very interesting piece of the investing portfolio, because not only can you most likely get that minimum 8% we've been talking about, but you may get quite a bit more on that. And so that makes it a very interesting. Now, it's not a very liquid investment, but it has a potential for higher growth, higher rate of return growth.
And just to make a quick comment, to put some kind of real numbers to this property here, that's $145,000, a 3-bedroom, 2-bath home. A 20% down payment on this is $29,000 exactly. So the math is
also calculate in whatever renovations you did. So we want to make sure we add that in as well. I don't know if that's 10,000.
No. The 145,000 is the fair market value of that property. It's if you were renovating a property, you would refer to that as the after repair value. But that doesn't apply to most people that are looking at this, because they're coming in saying, I'm investing in real estate. I've got investable capital. Let me shop around and find, the best deal I can. Here's one of them. They're not doing anything in terms of renovation. They're right. Not getting their fingers dirty. They're not rolling up their sleeves.
No, exactly. But if you did do renovation, you need to add that.
Yes.
You must
add. No, that's already built into that price.
Also has to go in.
Yeah, no, the renovation cost, Faith, would be already factored into that 145, because this is, again, the after repair value. This is the market value of this property. So someone coming along and saying, I want that property, they're gonna say, okay, well, I need to put 20% down. That's $20,000, just 20% of 145. What I'm trying to illustrate here is how did we get to this cash on cash return of 9-point-something%? Very simple. You take that cash flow, the annual cash flow of $3,063, and you divide that into your down payment of $29,000. So if you grab a calculator, it actually works out to be 10-point-something%. It's more than what you see on the screen. The reason it's lower on the screen is we've also plugged in the closing costs, the closing fees involved in the purchase of that property. So it's a more conservative example of what you're seeing there on the screen, but it's like 9 to 10%. That's how you do it. You take your cash flow, divide it into your down payment. That's the return. That's the real actual cash return you're getting in your first year. So that's how it's calculated. Okay, so this is basically the step-by-step process of what you would do, doing it on your own, doing it with a friend, doing it with a company like ours, doing it however you did. This is how I did it. I'm oversimplifying it a little bit, but it gives you just a very clear framework of a top-down approach that you would take in investing in any market, even your own backyard. So I always like to say that you should really start with your goals and criteria. What is it you're trying to achieve? Where are you today? Look at where you are today and where you want to get to. I just exchanged an email today, and I did a podcast episode recording of someone who emailed me that has a goal of 25 rental properties, and they've got 6 or something right now. So, they're mapping out their plan. But understand what your goals are and then define your criteria. And if you don't know what this is, you got to think about it or work with somebody who can help pull that out of your head and map it out. I'm looking for these types of properties with this types of cash flow in maybe this type of neighborhood. It might be a 3-bedroom, 2-bath. I'd like a minimum of $200 or $250 net cash flow every month. whatever that is. Define your goals, define your criteria, because if you know what those are, it's like a compass. It'll point you in the right direction, and you know if you're on track. But if you get off track, you know you're off track, and you get back on track. The second thing you do is something that we've been talking about, and that's choose the best market for you. Do you want to be in a cash flow market? Do you want to be in a growth market? Do you want to be in a hybrid type market? If you're not sure, again, you work with your team, talk to someone like us or whoever it may be. Maybe you already know. Maybe you've been, in online forums and you've been doing your research already, and you've identified particular markets like Indianapolis or Kansas City or Jacksonville, Florida, to be the markets that you really should be in, because it's going to give you all the benefits that you want to be or to want to have as a real estate investor. And there's tons and tons and tons of free information online in terms of markets and market information. I mean, we aggregate a lot of that. We do our own market due diligence and research with tools that we use. So we have pretty deep insight into what's going on in the different markets. And we talk about it on my podcast as well. I even do, market spotlights and provide that information on our website for people who want to actually, learn about it and read about it. But you pick a market. You don't have to be all over the map. Just pick one market. Then you need to assemble the right team. What does that mean? You're going to surround yourself with about 5 people that are going to be your key team players. The first person or company or group of people will be your acquisitions people. Those are the people who are going to help bring the deals to you or find the deals for you. It could be a turnkey provider like us. It could be a local real estate agent or real estate broker. If you're actively involved in swinging a hammer, it could be a wholesaler. But it's basically someone who's bringing deals to you. The second person or group or company is your property manager. And this is probably one of the most important people on your team, because I jokingly say you live and die by your property manager. Property management is a thankless job, and it's critically important. You need to understand the local market. You need to understand people skills, marketing skills, tenant landlord laws, negotiating skills, processes and systems, and just have a team, kind of a sub team, if you will, for people like handyman and general contractors to step in if they're ever needed to, fix a leaky faucet or replace something on the roof or whatever it may be. So, having the right property management company, full service property management, is critically important. So you have your acquisitions person, you have your property manager. You need one or more lenders or mortgage brokers, people who are going to help you get the financing to acquire these properties. You will have a real estate or asset protection attorney. Sometimes that's one person, sometimes it's a combination of 2. There's many people out there that do that service, but working with the right attorney is important. And of course, the right tax advisor, tax professional. Those are the key 5 people on your team. There's going to be other people you work with, such as appraisers and home inspectors and whatnot. And those are people that you use only now and again. So that's your team. You can vet these people. You can get referrals, recommendations from others. We vet the teams that we work with, so we hand them over to you if you were, working with us. But you can do the due diligence, and you can find these people, or you could talk to people who already work with these people and just have them refer them over to you. But you need a team. Robert Kiyosaki says real estate investing is a team sport, and he's absolutely right. So at this point, now you're going to choose good properties. So what does that mean? Once you've identified the market, now with your team, you're going to identify the neighborhoods or areas within that market that you're going to be investing in, and then you're going to be looking at and analyzing properties, specific properties within those areas. And ultimately, you're just going to shortlist them. You might start off looking at 10, if you can find 10, but you'll narrow it down to your top 3. And at that point, you're going to narrow it down to the top 1. So if you're buying 2 at the same time, you're top 2. But ultimately, you pick the best one of the ones that are available at the time that you're looking to invest. And then once you have that property identified and you've done your initial due diligence and your initial analysis and things are, checking off, all the boxes, you put it under contract, you have it inspected with a professional home inspector. That might be 2 inspectors, but it's usually 1 home inspector. And then you go into escrow, and these happen in parallel, and you continue working with your lender to get your financing in place, because that could take 30 days or more. And ultimately, within 30 to 45 days, you're going to have your inspection done, you're going to have your financing in place, and you'll be at the closing table, figuratively speaking, at the closing table. You're signing, docs that are FedEx to your home. You get them notarized, put them back in the FedEx envelope, you send them back, and the next day you're the proud owner of that next rental property that you've just put into your portfolio. And when you look back at this process and you've done it a couple times, you'll look at it and you'll say, you know what? It's not rocket science. It's not complicated. It's just following a methodology and using common sense to pick, the right market and the right neighborhoods and the right properties and having the right team. And you can just rinse and repeat and keep doing this until you get to whatever your investment goal is. That could be 10 properties, could be 5 properties, could be 25 properties. Everybody's got a different number. Everybody's got a different financial freedom number. And so you just work your way there. So that really is the process, at a 20,000 foot level. So I know you want to do some Q&A. I just got a couple slides in here. If you want to read a good primer that I put together probably 10 years ago, there's a 30-some page guide on our website you can download. There's no cost, of course. It's the ultimate guide to passive real estate investing. It talks about everything we just talked about and then some, but it's a great primer. That's being turned into a full-fledged book, which is written. I have manuscript, it's just not published yet, but I am intending to give the book away for free. So if you sign up for it on the website, you will get a copy of the book. And last but not least, I mentioned it a couple times, the podcast, Passive Real Estate Investing, and the home is passiverealestateinvesting.com. So those are the things I wanted to talk about today, Faith. So if we have time, I'm happy to take some questions.
Awesome. Great. Thank you so much. Okay. So while you guys are thinking about your questions, I just wanted to kind of bring up another point about how this fits into the overall plan. I remember I looked at real estate investing a while back thinking, oh, I'll make cash flow income off of it and be able to live off of my rent. But then when I looked at those numbers and I was like, $200 a month? Like, how many freaking properties am I going to need to make $10,000, a month? That's just not going to work. So the thing about this is that, and we're going to get into this on the, I think maybe Adele will talk about this more. And if you watch the video I posted on the website in the Facebook group, please watch that video he did. But one of the things you look at is you're not going to pay that mortgage on that property forever, right? The mortgage actually, the value of that, if you use like a 30-year fixed rate mortgage, the value of that inflation will inflate out the value of the mortgage. And then after maybe 15 years, right, with inflation, the rents go up on it. You'll start making more cash flow off of that property potentially. And you may just pay off the mortgage entirely and then be getting a much higher cash flow from that property. So we want to look at this not just like I buy this property and I get to quit my job today and live off of the money that's coming in from the cash flow. It really doesn't work that way. And honestly, that was one of the things that I was thinking like that 10 years ago, and that was one of the things that stopped me from investing in property because I didn't understand this correctly. It's more of you need to look at these properties with more of a longer term investment profile. So you're going to be, that might be 10, 13, 15 years where you're looking at getting yourself set up for that time period. For now, it's mostly just, you're letting that value grow. And you're going to get to a point when, yes, it can support you and you'll be getting a lot more cash flow out of it. But that's not going to be, it's not where you put your money if you're expecting to live off of it right now. So
yeah, Faith, that's a good point. Everybody starts somewhere, but you can build tremendous wealth and passive income by adding, one property or 2 properties at a time. It's going to be different for everybody because everybody has a different level of income and a different level of or speed that they can save and accumulate the next down payment for each and every property. But when you're in growth mode, what you're doing is you're trying to build your real estate portfolio as fast as you can. And if you're looking for equity gains, you're obviously building your portfolio as fast as you can in markets that will give you strong price growth. But what you're going to do in time, after 2, 3, 5 years, is you might rebalance your portfolio and grow it, and you continue to grow your portfolio till you get to a point where you believe you have enough properties to start shifting into a mode where you now accelerate the payments. When you don't want to grow the size of your portfolio anymore, then what you start doing is you start funneling cash flow to pay off one mortgage at a time, and you basically just knock them down like dominoes. And that's when you start to see, a larger increase in your cash flows. But the other thing that happens too is as the years go by, maybe not every single year, but your rents will go up. Your mortgage is fixed. If your mortgage payment on a property is $500 a month today, well, as time goes on, that $500 doesn't change, but your rents will go up, maybe 2, 3, 4, 5% per year, sometimes more. That's been pretty consistent here for the last 10 to 12 years. Probably 8 for sure. We've seen rents go up. So rents will continue to go up. Your mortgage payments are fixed, so your net cash flow will continue to go up as well. So that's the other factor. And then last but not least, just to touch upon something real quick that you said, Faith, is inflation is your friend as a real estate investor, like big time. Because one of the things that it does is it eats away at the real value of your mortgage. Your mortgage doesn't change every year to adjust for inflation. It's fixed. So that $500 today in like 10, 20 years is going to be the price of a Starbucks coffee. It's really, it doesn't adjust for inflation. So it becomes worth less each and every year because it's being eroded by the effects of inflation. So as your rental income goes up and the property value goes up, the value of your mortgage actually goes down because it's being eroded because of inflation. And actually, if you do the math on the amortization, here's a little side tidbit for you. If you look at a 30-year loan and you're amortizing it or paying it off over the course of 30 years, if you actually look at what is being paid down by your tenant, by the way, the average rate of return on just the pay down on that mortgage averages out to be 13.3% per year over the course of that 30 years. So, you have an automatic built-in rate of return just because your tenant is paying down your mortgage if you had nothing else. So that's kind of a cool little side factor that most people don't even sit down to think about. But you just do it in a spreadsheet and you can calculate it. So
I have a question, and then if any of you guys want to I see we've got some stuff in the chat. People are saying thank you so much for the call. They'll be in touch. Thank you for the knowledge. So that's great. Getting a lot of thanks in the chat. One thing I want to point out with this is what you said about what's the cost to get started? Because I think a lot of people, especially those of us that have lived in New York and California, we think, oh my God, you have to have $100,000 down payment just to get a condo. So this is very, very different. I think it's a lot more manageable. What would be the cost to sort of get started and get into your first property?
I don't know who asked that question, but it's a great question. And I actually love that question because I love the answer. So let me just kind of do a quick brain dump on you here. So as far as the 20 some markets that we operate in, if you look at the range of properties, they range from about 70, 80,000 on the low end to about 180,000 on the high end. That's the range. The median price of a single family home, typically it's a 3-bedroom home, is around 120,000. That's the median price of what clients are purchasing today, just because that's the range and that's what is ending up being the median price. Average is close to that too. Now, simple math, it's 20 for conventional financing, it's 20% down. So 20% on a $100,000 home is $20,000. On a $120,000 home, it's, what is it? 26,000, 24,000, 24,000. So what you need to get started is really your down payment and closing costs. So it's 20% of the purchase price. If it's a $100,000 home, simple math, we'll call it $20,000. Budget about $2,000 to $3,000 for closing costs, lender fees, miscellaneous, the cost of your appraisal, which, plus or minus is about $500. So all in, you're probably all in for about somewhere around 23,000, maybe a little bit less.
So if the down payment on a
I was using 100.
$125,000 home, we're saying 20%,
Yeah.
that's 25,000. So then
Okay.
what would be the closing costs usually of that?
But budget about 4% or $3,000, the greater of.
Okay, so let's look at 4% of that then.
And it's usually not that high, but I'm just giving you like.
Right, but we want people to be, it's more really like, okay, if I go into this, I'm not going to be forced into a position where I'm paying a lot more than I'm comfortable with. So that's like an extra 5,000, 4% of 125,000, right? So in that case, you're looking at around $30,000.
Yeah, that would be on the high end.
On the high end to cover everything, your down payment and your closing costs for like $125,000 property. So it's about $30,000. So if that's in your, you want to have that kind of chunk in your savings account. Now people do other things. I want to say that you don't go jump right in and go grab a house right now, because we're going to be doing some talks on, like, do you want to do this in, say, a 401k? Do you want to use that to invest in property, or other types of vehicles that you put that property in when you purchase it? So we're going to be talking about that coming up. But this is a great time to get started if you're interested in doing this, to start to learn about it, to start to listen to Marco's podcast, to start doing research on neighborhoods and like get going with that initial educating yourself on those things, so that as we create this map and this plan and we think about what vehicle you might put it in, when you're ready, when you have that kind of figured out, then okay, now I know what I'm doing. I've already started the learning process. I'm ready to get going with it. And people will use, so let's say maybe you don't have that full 30,000 yourself. Maybe you do, maybe that's an easy, maybe it's an easy win for you. But people will often invest together in a property. So, you might bring 15, somebody else might bring 15, and you can invest together in it. So there's other ways to get that together if you want to start getting into this. Is that right, Marco?
Yeah, that is correct. Yeah, your numbers are spot on. The oversimplified example is the $100,000 property, 20% down is 20,000, 3,000 in closing costs. You're now at 23,000. I always suggest, especially in the beginning, that you have an operating account or a reserve of 2 or 3 months worth of rent. So if it rents for $1,000 a month, have an extra $2,000 or $3,000 on the side in your operating account. You don't touch it, but it's there just in case you need it. So call it $25,000. You can get your first 3-bedroom rental property in a good market, in a good neighborhood, for about $25,000. If you've got $50,000, you got 2 properties. If you can save $25,000, $50,000 a year, great. You're buying 1 or 2 properties every year to add to your real estate portfolio. If you make a lot more money, if you have a lot more in savings, if you have investable cash in a self-directed retirement, great. You've got a huge head start. To take all that even one step further, I don't judge who's listening on this call or anything like that, but we find a lot of people who are in California and New York, these expensive states, have 1 or 2 properties, their principal residence in another property, and we find, and I joke about this, I say they're equity rich and cash flow poor, because they are sitting on a ton of equity, some of them, and they don't realize that they can do a lot with that. And so if you are able to tap into some of that equity and turn that into income producing cash flow assets, like income producing real estate, you're not spending the equity, you're just moving it and putting it to better use. Why? Because the equity in your home or the equity in your other properties, the rate of return on that equity is essentially 0. It's not producing any cash flow. But if you can release or tap into some of that equity and move it into assets like rental income, rental
In a
properties
better
that produce,
market.
yeah, in less volatile markets, you're not only protecting that equity, but you're turning it into passive income each and every month and every year, and you're growing your equity faster because you've got it geographically diversified and also spread across multiple pieces of real estate, not just the one home in California that goes up and down and up and down, like whatever. So, the point is people have untapped potential, and they can do a lot when they actually have equity that they can tap into and or investable funds in retirement accounts. So
Awesome. Thank you so much. Okay. Does anybody have any questions? We've gone on for, almost an hour and a half. So I don't want to keep Marco on here too long, but please let me know if you have any questions. You can put them in the chat, or you can unmute yourself and you can ask away. Anybody have anything else?
I saw Lawrence drinking from his mug there a minute ago, and it's the Tigger mug from Disneyland, and I love it. I got the exact same mug.
Yeah, it's the wonderful thing about Tiggers.
My wife loves Tigger, favorite character. So
yeah, I do. I as since we're talking about that, just one quick question: what do you feel is the unseen? What is the thing that people don't think about, like the most important thing that people don't think about when going into this? What is the one sort of thing that you just have such limited awareness of or experience, and you're like, damn, if I only knew that, what might that be?
I think another way of saying or asking what you're asking is what are one of the common mistakes that real estate investors make, especially new real estate investors. Well, here's one of the big ones, and this is one that I made in the beginning. A lot of people who we lovingly refer to as newbies will come to us and say, I'm just getting started, or I'm thinking about real estate investing, and I'm thinking of, dipping my toe in the water, or again, air quotes, starting small.
Yeah.
And what they're thinking, they are exposing themselves to less risk or less downside potential or fewer issues if I invest less in the beginning, just to kind of try it out or put my toe in the water. So they look at $60,000, $50,000 properties because it's a much smaller down payment. It's like $10,000, $12,000 plus closing costs. That's not, you're not going to lose a lot of sleep if you lose that $10,000. You can probably recover pretty quickly from that. But the mistake they're making is that if you're investing $10,000 or $15,000 as a down payment, you're investing in a $50,000, $60,000 home, and now you're automatically putting yourself into a C, maybe a D class neighborhood, in some of these, more affordable markets. That's a mistake. If you want a good experience right from the get-go, put yourself in the right neighborhood, in something you can identify with the right demographic, who is your customer right from the get-go. Serve the people that you understand and you're comfortable with. And that's, for most people, I find, it's really investing in markets that are, well, of course, the good markets is assumed, but in neighborhoods that are B plus, A minus type neighborhoods. So I suggest go for that $130,000, $150,000 property, invest a little bit more. Look, at the end of the day, things are going to work out better in your favor, because you're still getting a good cash on cash return and a cap rate and cash flow, but the demographic is better, the stability of the neighborhood's better, the quality of the asset is better, the potential for it to appreciate is better, the comps in the neighborhood are better. If you had to sell it down the road, you're going to have a better exit strategy. You have a better market to sell to because you have a larger buying pool. The management is going to be easier for your property manager, and fewer headaches for them, fewer headaches for you. Not that there's many of those, but you're buying yourself headaches in the C-class neighborhoods. So don't think you're doing yourself a favor by, quote unquote, starting small. Get a better property with a better tenant in a better neighborhood right from the get-go. In fact, some people just build their entire portfolio focused on A-class neighborhoods. They're not getting a great cash rate or cap rate or cash on cash return, but guess what? They make out like bandits over the years in terms of appreciation that they get, just because they're buying in good markets, like growing markets.
That makes sense. Cool. Thank you.
We have one more question. Can you speak to multifamily properties versus the single family home?
Well, multifamily could be classified two ways. Anything that's 1, 2, 3, or 4 unit, so up to a fourplex, is classified as a residential property from a lending perspective. If you're over 4 units in one property, that's considered a commercial property. Now the lending changes. You're now dealing with commercial loans with different terms, not as favorable, and it just operates differently. So multi-unit can be 1, 2, like duplexes, triplexes, and fourplexes. And our clients purchase plenty of those. Usually they're new construction duplexes, new construction fourplexes, because when you get over the single family home, it's really hard to find much inventory across the country right now that are duplexes and triplexes and fourplexes that are not in like areas that you don't want to be in.
That are not
Everybody,
C-class neighborhoods.
yeah, they're in better areas. Everybody wants them. Everybody's been chasing them. People like, the duplexes and fourplexes. I like them too. I mean, I've had my fair share of duplexes and fourplexes. The financing is different when you get over 4 units. The thing I don't particularly like buying anything larger than a fourplex. Some people will say, well, hey, the more units you have, the lower your vacancy when you have a vacancy. Well, that's not really true, because if you have 4 units, whether it's all in one package as a fourplex or you have 4 single family homes, if you have 1 vacancy, you still have 25% overall vacancy in your portfolio. So, that whole thing about going big and buying bigger properties is beneficial is not true, because a vacancy is a vacancy. It doesn't matter. It's really about the size of your portfolio. The other thing too is, anecdotally speaking, I find that you get the best quality tenants and the most caring tenants in single family homes, because there's more pride of ownership. There's more privacy. You don't have shared walls. So I think the larger the multi-unit property that you're investing in, again, anecdotally speaking, but a lot of property managers will verify this, you tend to get a slightly better quality tenant. They are sometimes more transient, so they tend to move a little more often. And also, generally speaking, the larger the complex, the more number of units, the lower the income of that demographic, because you're catering to more of an apartment type dweller, or someone who's not committed to home ownership, at least not in the foreseeable future. So there's nothing wrong with a fourplex. The fourplexes that we're building and selling right now are actually in prime A-class neighborhoods. Like, they're in some of the best areas, from Phoenix to Houston to places in Idaho. So they're extremely nice properties, very well appointed, stuff that you would find in Southern California, like in the coastal markets. So, but they're just sitting in A-class neighborhoods. So I'm not exactly sure if I'm answering the question, but I can only give you kind of a general answer to what I think is being asked.
Yeah, no, I think that was great. And also, if you want to go take a look at the video I posted in the Facebook group that ADL did, he gives his perspective on also why you might prefer to invest in single family homes over these type of multi-unit properties as well. So awesome. Thank you so much, Marco. This was fantastic. Everybody has been very appreciative in the comments. If anybody wants to come on and say thank you to Marco, he did a great job. And please go check out his website and his podcast so that you can start educating yourself. Use the calculator on there as well. And you can start educating yourself and getting ready so that, when we build this cool map, you're ready to go. Okay?
Thank you, Marco.
Thank you.
I
Thanks so
appreciate
much.
you guys. Thank you very much. It's been fun.
Bye.
Bye, everybody.
See you, everyone.
Bye. Marco,
Bye.
can you return the host control back to me?
Yes. Stop sharing. Hold on a sec there. You got it?
Let me see. I'm just trying to end the recording. Nope.
You
Still don't
don't.
have it. Can you end recording? I know how to do that. Stop the recording. hit the
Here,
record.
I made you the host.
Thank you. All right.